Hello, hi everyone. Hope you people are doing great. This video is a continuation of the last session. In the last session, we discussed the definition of accounting and its purpose. We also discussed the details about the accounting and individual heads of accounts and the accounting equation. Okay, so now we would further drill down the head of accounts into categories to get the better understanding of each head. Let's start with assets. Well, in the last session we studied that assets are properties, vehicles, cash, etc. that you own and use. Now assets can further be categorized into current assets, as the word current suggests, assets that can be reasonably converted into cash within a year. For example, your accounts receivable. Now what are these? You make sales to your customers and they pay you after an agreed time period. Now these are your receivables. You have to receive money from your customers, and this is your asset. Inventory or stock. The goods, products that the company holds for the ultimate purpose of resale. It means that the inventory you are holding with you. Now you're going to sell it and you'll receive cash. So these are also your assets. Prepaid expenses. Now what are these? The expenses that you have paid for before consuming the service. For example, prepaid rent, prepaid mobile cards, prepaid internet cards, prepaid insurance, and etc. Well, this is the reverse of liability as we discussed it in the last session. Cash and cash equivalent. Cash can be cash in hand and cash in bank. Normally, cash in bank is used in the banking terms, and mostly businesses use banks as their cash transactions. Cash equivalents can be marketable securities, shares, bonds, etc. Non-current assets. This is another category of assets. Non-current assets are assets that are used for more than a year. In other words, their full value will not be realized within a year. For example, you purchase properties, plant, equipment, machinery, furniture, fixtures, long-term investments in other companies, etc. Take a small example, you purchase a laptop and you can use it for more than a year. This is your non-current asset. Let's now move forward and let's start with liabilities. Likewise, liabilities can also be subcategorized into current and non-current liabilities. Current liabilities, as the word suggests, liabilities that need to be paid off within a year are current liabilities. For example, rent expense payable, insurance payable, interest payable, accounts payable. This is the reverse of accounts receivable. Accounts payable is that you purchase goods from suppliers to whom you pay after an agreed time period. You have not paid for these goods, you have to pay for it afterwards, so this is your liability. Well, they are also known as your creditors. Now, non-current liabilities. Non-current liabilities are liabilities that are not due within a year. In other words, they are not required to be paid within a year. For example, long-term loans. You acquire long-term loans from banks which you not need to pay within a year. You have to pay, say, in 5 years' time. So this is your non-current liability. Let's move forward. Equity. Equity is the money you actually own, as we discussed in the last session as well. Now, in a company, there are many shareholders who hold shares of the company, means they are the owners of the company with respect to the number of shares they hold. In a sole proprietorship and partnership, this is replaced by owner's equity as there are no shareholders there. Sorry. Let's move forward to income revenue. Income can be any income earned by a business, for example, sales income, commission income, rent income, interest income, etc. Expenses. Expenses can be any expense borne by the company. For example, cost of goods purchased. You bear a cost for purchasing the goods that you need to resell. Interest expense, mostly on loans. Commission expense, salaries expense, rent expense, insurance expense, administration expenses, sales and distribution expenses, etc. Well, now we have got detailed understanding of the heads of accounts, but still, if you need any more clarification, you can comment and we will do the needful. Now let's move onwards to the concept of debit and credit. Well, the essence of accounting is the debit and credit entries. This is also known as double entry system. The whole concept of accounting revolves around the debit and credit. A debit is an accounting entry that increases or decreases the heads of accounts. Likewise, a credit is an accounting entry that also increases or decreases the heads of accounts. To clarify these concepts, let's understand it through a table. Now here, assets increase when they are debited and decrease when they are credited. Liabilities decrease when they are debited and increase when they are credited. Equity decrease when they are debited and increase when they are credited. Income decrease when they are debited and increase when they are credited. Expenses increase when they are debited and decrease when they are credited. Now this seems a bit tricky, but this is what debit and credit is. This is the concept of debit and credit. I hope you understand this concept, but it can be clearly explained by the help of an example. Let's move towards the example. Example number 1. A company started its business with ₹1 million by raising shares from public. Now the accounting entry would be cash in bank debit and share capital or your equity credit. Debit accounting entry for cash is passed as the cash is increasing, as it is your asset, and asset increases and it is debited. Whereas credit entry is passed for equity, as your equity increases, it is credited. Let's go towards the second example. The company purchased non-current assets worth ₹500,000. Here, debit accounting entry is passed as non-current assets are increasing. Assets increase, it's debited. And on the other hand, credit accounting entry for cash in bank is passed. As cash in bank is decreasing, your asset is decreasing, so it is credited. Quite logical. Third example, the company borrowed a long-term loan of ₹100,000 from a bank. Now you receive loan in the form of cash, and cash is increasing, so your asset is increasing. So it means that a debit entry for cash and bank is passed, and since you borrowed a loan, so your liability is also increasing, so a credit entry for long-term loan is also passed. Let's move on towards the fourth example. The company paid for interest expense of ₹5,000 to the bank. As you have taken loan from the bank, you have to pay interest cost on it. So a debit accounting entry for interest expense is passed as your expense is increasing, it's debited, and as you're paying cash, your assets are decreasing, so cash in bank is credited. Now the fifth example, the company purchased goods from suppliers on credit worth ₹100,000. Now here, inventory stock is debited and your accounts payable or creditors are credited. A double entry is passed for stock inventory as it is your asset, and as assets increase, they are debited. And accounts payable that you have to pay to your suppliers, they are also increasing. Means that your liability is increasing and they are credited when the liability increase. Now let's move on towards your sixth example. The company sold goods to customers on credit worth ₹65,000. Now here, you did not receive cash when you sold goods to your customers. So you will receive money against your sales from your customers. So your asset has increased. Accounts receivable debit and sales credit. A debit entry is passed for accounts receivable, the amount which you will receive in the near future, that you will receive within a year. So it's your current assets. And a credit entry is passed for sales income as it is also increasing. Income increases, it's credited. The company. Now let's move on towards the seventh example. The company sold goods to customers on cash worth rupees 50,000. Now these goods are sold on cash, so your cash is increasing with rupees 50,000. So debit entry is passed for cash. As cash is increasing, it is debited when your asset increases, and your sales income is also increasing. So when income increases, it's credited. Quite logical, and it's very easy to understand, just a bit tricky. You need to just go through these concepts. Well, this ends our session for today. Hope you understand the concepts of debit and credit. This is just the beginning. This is a bit tricky. Remember the table of debit and credit as discussed before, and you must recognize the item correctly. That is, whether it is an asset, liability, equity, income, or expense, and then pass the accounting entry. Just go through the examples as we discussed before. Other examples and questions will be discussed in the next session, and we will move a bit further with some complex accounting entries and their postings in general ledger and trial balance. Now, what are these? We will discuss it in next sessions. For now, it's end for today's session. Please like, subscribe, and share my YouTube channel. And if you need any other stuff, just contact on my channel and we will have it done. Thanks and bye.